In recent years, a growing wave of political tension, economic pressure, and global uncertainty has forced many nations to reconsider their long-standing relationships. Among these shifting dynamics, one of the most significant and controversial decisions has been the attempt by several Western policymakers to distance themselves from China. This approach, often referred to as the Cancel China Plan, was initially promoted as a straightforward strategy to reduce dependency, regain control, and protect national industries. But today, as new reports emerge and data becomes clearer, many analysts are beginning to question whether this strategy has actually produced the outcomes its architects promised. What was once presented as a bold step toward economic independence is now being examined through a more critical lens. Economists, researchers, and industry leaders are finding that the consequences are far more complex than political slogans suggested. The ripple effects of this plan, especially on manufacturing, technology, and global supply chains, are becoming harder to ignore. Each new report adds another layer of evidence, showing how deeply interconnected the world's economic systems have become and how difficult it is for any major nation to abruptly unwind those ties without facing unexpected challenges. These findings have started to trigger debates inside government offices, corporate boardrooms, and academic circles. Many are beginning to ask whether policymakers underestimated the economic reality or miscalculated the long-term impacts. The more data that comes out, the more it appears that certain assumptions, particularly those regarding job losses, trade balances, and industrial decline, may not align with what is happening on the ground. In fact, some of the losses previously attributed to China are now being linked to automation, technological shifts, and structural changes within domestic industries. This raises a critical question. If the root causes were misunderstood, then were the solutions built on faulty premises? This discussion has gained further momentum as multinational companies respond to these political pressures. While some have attempted to diversify supply chains or relocate production, many have discovered that the alternatives come with their own set of challenges. Higher costs, limited infrastructure, and shortages of skilled labor in replacement countries have made transitions far more complicated than anticipated. Even companies willing to move quickly are learning that severing decades-old manufacturing relationships cannot happen without serious consequences for efficiency, pricing, and product availability. Meanwhile, consumers are beginning to feel subtle changes as well. Prices of everyday goods from household electronics to basic tools have gradually increased, reflecting the additional burdens placed on businesses. Production delays, inventory shortages, and reduced product variety are slowly becoming part of the new normal. While these effects are not always directly linked to the Cancel China Plan in public discussions, industry experts confirm that supply chain restructuring plays a substantial role. As all of this unfolds, political leaders continue to defend their decisions, emphasizing national security concerns and long-term strategic goals. But the gap between political messaging and economic reality is becoming increasingly noticeable. Reports released by manufacturing associations, technology groups, and global market analysts repeatedly highlight the same point. The world's economic ecosystem is deeply interdependent, and trying to untangle it through abrupt policy shifts creates complications that no one can fully predict. This entire situation has now reached a point where policymakers, corporations, and citizens alike are forced to revisit the big question. Did the Cancel China strategy truly strengthen national resilience, or did it unintentionally weaken key sectors? As more evidence comes to light, and as the impacts spread across industries and global markets, the need for a clear and honest assessment becomes more urgent. As new assessments continue to reveal deeper insights into the economic shifts taking place, it becomes increasingly clear that many of the earlier assumptions about China's impact were based on incomplete interpretations. What once appeared to be a simple narrative blaming the rise of Chinese manufacturing for domestic job losses now seems far more multifaceted. Numerous studies show that automation, advanced machinery, and changing production methods have played a much larger role in reshaping employment patterns than previously acknowledged. This realization complicates the political narrative that reducing reliance on China would automatically restore manufacturing strength at home. Policy analysts across various sectors now emphasize that the global economy does not operate on linear cause and effect relationships. Instead, it functions through layers of interconnected systems that rely on predictable cooperation. When a major link in that chain is altered, The effects cascade in ways that are often underestimated. Many industries, especially technology and automotive manufacturing, have come to depend heavily on specialized components produced in large volumes and at low cost in Chinese factories. The notion that these processes can be easily relocated overlooks the complexity required to maintain the same quality, speed, and efficiency elsewhere. As corporations attempt to adjust to these shifting conditions, internal assessments reveal the magnitude of the challenges they face. Transitioning production hubs, even partially, requires re-establishing entire ecosystems from supplier networks and logistics routes to workforce training and infrastructure capacity. Many companies that initially announced ambitious relocation plans are now finding that the financial and operational costs exceed their projections. Some have slowed down their transitions, while others are quietly reconsidering whether complete decoupling is even feasible. This gradual pullback is also reflected in investor behavior. Financial markets respond quickly to uncertainty, and every new trade restriction, regulatory shift, or geopolitical tension creates waves across global exchanges. Investors monitor these developments closely, understanding that even minor disruptions in cross-border cooperation can produce major shifts in pricing, supply stability, and long-term business planning. Companies heavily dependent on Chinese manufacturing become particularly sensitive to policy changes, as any interruption can directly influence production timelines and revenue forecasts. These uncertainties have also impacted innovation cycles. The development of new technologies often involves multinational collaboration, shared expertise, and synchronized production schedules. When those links weaken, innovation slows. Products that once moved smoothly from research to manufacturing now face delays due to disruptions in component sourcing or changes in compliance requirements. For consumers, this means fewer new model releases, longer wait times, and higher prices for advanced devices. Meanwhile, the job market continues to adjust in ways that are not immediately visible in official reports. Instead of mass layoffs, many companies are gradually modifying job structures, reducing hours, shifting roles, or relying on contract-based labor to navigate uncertainty. This quiet restructuring affects long-term job stability, even when unemployment rates appear steady. Workers in manufacturing-heavy sectors particularly feel the pressure as companies struggle to manage higher operational costs brought on by supply chain adjustments. All of this contributes to a broader discussion about the future of economic policy. As experts examine the growing body of evidence, the question becomes not just whether the Cancel China plan was effective, but whether it was grounded in an accurate understanding of economic reality. The more the data is studied, the clearer it becomes that global systems cannot be reshaped through abrupt, one-directional policies without significant consequences. The challenge now lies in determining how to move forward in a way that protects national interests while acknowledging the unavoidable interconnectedness of modern economies. As the impacts continue to unfold across industries, financial systems, and everyday life, the debate grows more urgent. Policymakers, investors, and citizens are now faced with the responsibility of reassessing previous assumptions and deciding which direction offers true long-term stability. This stage of the discussion sets the foundation for examining what happens next, and how nations can navigate a path that balances economic resilience with the realities of global interdependence. As the broader discussion deepens, a clearer picture begins to emerge regarding how different sectors are absorbing the pressure caused by policy shifts and market uncertainty. Technology remains at the center of this transformation, not only because of its economic weight but also because of its dependence on highly complex supply chains. These supply chains rely on precision manufacturing, specialized materials, and synchronized production hubs, many of which are located in China. When tensions rise or regulations tighten, these systems feel the impact almost immediately. Companies that once operated smoothly with predictable component shipments now face delays that disrupt entire product cycles. A small shortage in a single microchip or rare material can halt production lines for weeks. This is especially true in industries like electronics, automotive manufacturing, and renewable energy, where each product requires dozens of interconnected parts sourced from various regions. The more these connections are strained, the more companies must reconsider how they plan, design, and distribute their products. Financial markets track these developments closely, responding to every sign of potential disruption. Even minor diplomatic statements or new policy considerations can create significant fluctuations in investor confidence. Traders understand that when global supply chains become uncertain, production costs rise, profit margins narrow, and long-term growth becomes harder to predict. This sensitivity is amplified in technology companies, whose valuations depend heavily on expectations of stable growth and rapid innovation. At the same time, businesses across multiple sectors are quietly developing contingency plans. These plans involve evaluating alternative manufacturing sites, renegotiating supplier contracts, and analyzing how much risk their current operations can sustain. However, transitioning operations away from established hubs is far more complex than it appears. Many companies that attempted large-scale shifts quickly found that the infrastructure, workforce expertise, and scale available in China cannot be replicated easily in other locations. This has forced several corporations to reconsider their timelines and strategies. Workers across different industries feel these adjustments in subtle ways. Instead of immediate layoffs, many companies are reducing overtime, limiting hiring, or reassigning employees to new roles. While these changes often go unnoticed in official employment statistics, they reveal underlying weaknesses in the job market. The shift toward contract-based labor, shorter work schedules, and fragmented job structures reflects a labor environment adapting to uncertainty. For many families, this translates into reduced household stability, even though national unemployment figures may suggest otherwise. Consumers also begin to experience the ripple effects as supply chain shifts slow down production and increase transportation costs. Prices for electronics, household goods, and essential items rise gradually as companies pass increased operational expenses onto customers. Delays in product availability become more common, affecting everything from smartphones and laptops to home appliances and electric vehicles. Each disruption adds another layer of strain to an already delicate economic environment. As researchers continue examining the broader implications of decoupling efforts, they highlight how deeply interwoven global systems have become over the past 3 decades. The belief that one nation can rapidly restructure its economic dependencies without significant consequences has been challenged repeatedly by real-world data. Analysts point out that while diversification of supply chains is important, doing so too quickly creates instability, miscalculations, and long-term financial risks. In political circles, debates intensify as new evidence complicates earlier assumptions. Some policymakers argue that national security concerns justify aggressive restrictions, while others emphasize that economic resilience requires careful, calculated adjustments rather than abrupt decisions. The tension between these viewpoints creates an environment where strategies shift frequently, adding further unpredictability to global markets. International partners also watch these developments closely, recognizing that disruptions in U.S.-China relations affect far more than just the two nations involved. Global trade networks operate like a web. When one strand tightens or breaks, the entire structure shakes. Countries that rely on exporting components to China or importing finished goods from the United States face new risks as the political and economic landscape shifts. All of these factors combine to shape a narrative that is increasingly difficult to simplify. The situation is not defined by a single cause or effect but by layers of interconnected forces influencing each other across time. As discussions continue, the focus turns toward understanding how rapidly evolving policies and market reactions will shape the next stages of global economic adaptation. This sets the foundation for examining the long-term consequences and identifying what strategies may offer real stability moving forward. As the situation continues to unfold, the pressures surrounding global supply chains begin revealing deeper structural weaknesses that were previously overlooked. Many industries had grown comfortable operating within a highly optimized system centered on efficiency, speed, and low production costs. But this optimization came with a hidden trade-off, a level of dependence that left companies vulnerable to any form of geopolitical tension. Once policy shifts began introducing friction into these systems, the consequences spread far more quickly than many analysts initially predicted. Corporations that once believed they could easily redirect manufacturing to new regions discovered that alternative locations lacked the scale, infrastructure, and specialized labor needed to match existing capabilities. Establishing new production sites meant securing reliable energy sources, building logistics networks, training workers, and ensuring consistent supply of materials, each of which required significant time and capital. The assumption that diversifying away from China could be accomplished swiftly began to fade as the financial realities became clearer. At the same time, internal restructuring accelerated across numerous sectors. Companies launched cost-saving initiatives to shield themselves from uncertainty. But these measures often translated into shifting workforce patterns. Employees were reassigned into new departments, placed in hybrid roles, or transitioned into contract-based positions. While these adjustments technically maintained employment figures, they altered job quality and stability in ways that official statistics could not capture. For individuals and families depending on steady income, these gradual changes signaled a new era of insecurity. Meanwhile, the steady rise in material and transportation costs added another layer of complexity. Delays in obtaining components created cascading effects along production lines. A shortage in a single item, no matter how small, could stall entire manufacturing operations. As companies compensated by sourcing from more expensive suppliers or holding larger inventories, consumers ultimately felt the impact through higher prices and limited product availability. Items that were once frequently upgraded, such as laptops, smartphones, and household devices, now saw extended life cycles. As new releases slowed, financial analysts monitoring these developments noted that the underlying causes were interconnected, forming a cycle of pressure that fed back into itself. Tensions between nations sparked regulatory responses, which triggered supply chain disruptions, which then increased business uncertainty, leading to cautious investment behavior. Markets grew more sensitive to policy announcements, interpreting even minor changes as signals of larger shifts. This created conditions where volatility became frequent, and long-term forecasting grew increasingly difficult. Amid these developments, policymakers faced growing challenges in balancing economic resilience with strategic priorities. While some urged swift action to reduce reliance on foreign manufacturing, others warned that accelerating such processes risked triggering deeper economic instability. Data presented by researchers highlighted how crucial global cooperation had been in enabling technological advances over the past several decades. Attempts to rapidly separate systems that had grown tightly interwoven threatened to slow innovation and increase development costs across many sectors. International observers echoed similar concerns. Countries positioned within global production chains recognized that disruptions between major economic powers would inevitably affect their own industries. Nations dependent on exporting raw materials, assembling intermediate goods, or manufacturing specialized components faced heightened uncertainty. Some governments began reassessing their trade policies, investment strategies, and diplomatic engagements to navigate the shifting landscape. Throughout this period, the broader economic narrative continued evolving. What had once been framed as a straightforward adjustment began to reveal itself as a complex transformation involving technological, political, and social dimensions. Rather than viewing developments as isolated events, analysts increasingly interpreted them as parts of a larger and ongoing realignment in global economic systems. For workers, businesses, and consumers alike, these changes represented a long-term shift rather than a temporary disruption. Companies evaluated new risk management strategies, governments reassessed regulatory frameworks, and households adapted to altered patterns of prices and availability. The interconnected nature of modern supply chains meant that every adjustment carried implications for multiple industries, ensuring that the transition would unfold gradually over time rather than through immediate, dramatic shifts. As discussions continued, attention shifted toward identifying which sectors would face the greatest pressure moving forward, and how each part of the global economy would adapt. This deepening examination set the stage for understanding the emerging landscape, preparing the groundwork for evaluating the long-term outcomes that would define the next phase of global economic relations. As the global landscape continues to shift, the long-term consequences of the Cancel China movement are becoming more visible. What began as an urgent call for economic independence has gradually evolved into a complex series of adjustments, shaping industries, policies, and markets across the world. These adjustments are not happening in isolation. They are occurring simultaneously, creating ripple effects that reach far beyond the original political debate. One of the clearest signs of this transition is found in the ongoing recalibration of corporate strategy. Large corporations, particularly those operating in technology, automotive manufacturing, medical devices, and consumer electronics, are evaluating their exposure to international supply chains with far greater scrutiny than before. Their internal reports increasingly highlight the cost of uncertainty, delays, regulatory changes, fluctuations in shipping logistics, and the inflationary pressure produced by shifting production sites. While many firms continue to diversify, they are doing so at a slower and more calculated pace, recognizing that rapid decoupling carries risks equal to or even greater than dependency. These corporate strategies also reveal broader market reactions. Investors have become more sensitive to earnings projections that mention supply chain adjustments, production relocations, or rising operational expenses. Even minor warnings from companies can lead to notable shifts in stock performance, especially for firms with significant global exposure. This sensitivity reflects a deeper understanding in the financial community that global restructuring is not a temporary phase but a long-term economic trend. As a result, markets increasingly react to forward-looking signals rather than waiting for actual disruptions to materialize. Parallel to these financial shifts, policymakers are reassessing the strategic costs and benefits of ongoing tensions. While national security concerns remain a central justification for decoupling efforts, economic data illustrating rising prices, slower production, and stressed labor markets has introduced new debates within government circles. Some advisors argue that certain industries may benefit from selective partnerships instead of broad disengagement. Others emphasize that long-term competition does not necessarily require complete separation but rather smarter risk management. These discussions reflect a growing recognition that the global economy functions as an interconnected system, and that changes in one region inevitably affect others. Another dimension shaping this narrative involves the global reaction. Many countries, particularly in Southeast Asia, Europe, and Latin America, are now adapting their economic strategies to the shifting realities between the United States and China. Nations with strong export-driven industries are diversifying markets, negotiating new trade agreements, and strengthening regional supply chains to reduce their exposure to volatility. Meanwhile, developing countries are striving to attract investment by positioning themselves as stable alternatives for manufacturing. This global repositioning underscores how deeply the "Cancel China" narrative has influenced strategic decisions worldwide. Within the United States, workers remain at the center of this transformation. Although employment data often appears stable, the quality of work is undergoing significant change. More employees are transitioning into roles that offer fewer long-term guarantees. Job descriptions are shifting to meet the demands of new production methods, automation tools, and hybrid organizational structures. These changes signal that the labor market is not merely adjusting to geopolitical tension but is entering a broader evolution influenced by technological and economic forces. The contrast between official statistics and lived experiences continues to widen, creating a sense of uncertainty among workers and communities. As this environment grows more complex, attention is turning toward indicators that reveal where the next phase of the transition may lead. Analysts closely monitor inflation patterns, consumer spending trends, corporate investment strategies, and trade volume shifts. Each data point offers clues about how deeply decoupling efforts have penetrated the global economic system. Meanwhile, diplomatic engagements between the United States and China provide insight into whether tensions will escalate or stabilize in the near future. Even modest diplomatic cooperation can ease market anxieties, while strong rhetorical exchanges can increase volatility across industries. Amid these developments, technology remains the most sensitive sector. Both nations view advanced computing, semiconductors, and artificial intelligence as critical to their long-term strategic advantage. As restrictions intensify, companies operating within these fields must navigate a landscape filled with regulatory hurdles, licensing requirements, and shifting alliances. The need for innovation remains strong, but the environment in which innovation occurs has become more fragmented. This fragmentation influences research partnerships, cross-border investment flows, and the pace at which new technologies can be developed and deployed. In financial markets, these layered uncertainties translate into heightened volatility. Investors understand that long-term structural changes rarely unfold smoothly. As supply chains realign and industries adjust, periods of instability are expected. Companies that adapt quickly may emerge stronger, but those that rely heavily on outdated models face greater challenges. This dynamic creates pressure for firms to update strategies and remain flexible in the face of shifting global patterns. The broader implication of all these developments is that the Cancel China movement has evolved far beyond its original narrative. It is no longer simply about reducing reliance on one country. It has become a catalyst for reevaluating global economic integration, reconsidering supply chain vulnerabilities, and reshaping political priorities. Whether this transformation leads to greater stability or deeper fragmentation depends on how policymakers, companies, and investors navigate the challenges ahead. As the world enters this new phase, one fact is becoming increasingly clear. The consequences of these decisions will continue unfolding over the coming years, not just months. The path forward will likely involve a combination of cooperation, competition, and selective realignment rather than complete separation. Understanding this evolving landscape is essential for businesses, governments, and individuals seeking to adapt to the realities of a rapidly changing global economy. And as these shifts continue, the story that began with a single claim about job losses has expanded into a much broader economic transformation, one that will influence markets, innovation, and global relations for years to come.